Hey everybody, welcome back to Matt Money. Today we're going to be talking about the shares that I bought today, which was JPMorgan Chase. A lot of you guys are probably familiar with the company. A lot of folks are probably expecting it to drop like a rock today. It actually held up pretty strong. It actually was up above $100 a share at one point today, so it was actually up about 2%, and then it actually kind of evened out a little bit and ended up about 3% down compared to the rest of the market, which was actually up about 3% in total compared to where it closed yesterday. So we're actually above 2,800 again in the S&P 500, which is actually relatively surprising, and didn't really expect that. I was really expecting maybe more of a down market today, just based off of Wells Fargo and JP Morgan results. J&J actually blew everybody's expectations out of the water. I know it blew my expectations out of the water, especially with a 6% increase in the dividend. So I will be happy to collect another $25 a year just based off of that very small bump in the dividend payment. So thank you, Johnson & Johnson, for that. But what I wanted to touch on is the earnings per share might look pretty bad for JPM and Wells Fargo. But what I want to really dive into in this video specifically is looking at JP Morgan's reasoning as to why it's bad and why it's actually not as bad as it might initially seem. So obviously the market initially jumped, and then it kind of cooled off on JP Morgan throughout the rest of the day. And in all honesty, I agree with them. And that's why I took a very small position. I think it was like 10 shares or something like that. And I plan on anticipating over the coming weeks, if the market continues to kind of die down a little bit over the coming weeks, continue to build a position in JP Morgan. So, full disclosure, I also have about 300 so shares in Wells Fargo. And if Wells Fargo continues to drop as well, I might continue to pick up. But I'd rather purchase two of these good stocks at the decent prices that they're at the moment, uh, rather than specifically focusing on the one. And I personally believe that JP Morgan's balance sheet is slightly better at the moment than Wells Fargo. And actually, I just kind of want to look at the earnings reports relatively quickly and show you how simple JP Morgan really explained what they did this quarter and why earnings are quote unquote down so much versus Wells Fargo, which generally they're about the same, but I think JP Morgan held up a little bit better, and we'll touch a little bit why. Here's a watch list for you guys. I think I'm going to keep these down in the description below. It's kind of utilizing the Google Sheet tracker that I generally utilize, except it's very simplified, specifically focusing on companies that I want to buy in the near future if the price kind of comes in. So hopefully you guys can utilize that, and I think it might change throughout time. So I'm still getting used to having these kind of published to websites. So apologies if the link ends up not working, but hopefully throughout time it'll continue to work as expected, and you guys can keep an eye on prices or anything like that throughout time. So going on to JP Morgan's results here relatively quickly. So obviously they touch a lot about their COVID-19 response, or beer virus, as some people might say. But in actuality, it really seemed like they had a relatively good quarter. What they basically talked about a lot was their firm wide reserve build and why the impact happened the way it did. So obviously, generally, JP Morgan posts at least a $2.50 sort of net income per share every single quarter. But what they basically talk about is a little bit of adjustments for some things, and write downs, and obviously the reserve build, which are heavily going to impact everything, which ended up being about a $7 to $8 billion charge. And so they talk about this quite often. And actually, believe it or not, while they have this reserve build, that doesn't actually mean that they lost $7 billion in actual people defaulting on any loans or anything like that. It just means they're being precautious for something like that in the future. So they're basically booking ahead of time those losses before they actually occur. And this is actually a really cool slide that they put together. I don't know where they got the information from. But this wasn't something that I saw in the Wells Fargo presentation, but I thought this was really admirable slide for them to put together. and specifically talking about all the different kind of markets, whether it was restaurants, travel and entertainment, retail, supermarkets, all showing basically what happened over the past 6 weeks or up to a month or so ago, and really the impact that it then kind of had on the business or their business or just overall economy. And so what they're basically talking about is the drastic changes compared to average for forex, equities, rates, all this stuff to really try to hit home the craziness that this quarter and 1Q was, and kind of highlight how it'll kind of impact 2Q and beyond. And I think this is the slide that I want to focus on most. And so what this basically is talking about specifically is looking at 1Q 2020 compared to 4Q 2019 and the year over year quarter of 1Q 2019. And this is an over under. So this isn't saying that they only made $300 million in net interest income in 4Q. This is saying that they actually made an increase of $300 million compared to 4Q. Or actually the opposite. 4Q was actually $300 million higher, and it was flat with the year over year quarter. And what this is basically saying in the second line for net interest revenue is saying the same. Is it up or down? So compared to 4Q 2019, it's down 400 million. Compared to the year over year quarter, 1Q 2019, it's down 700 million. And so what this is basically saying is year over year and quarter over quarter, we're not seeing a drastic change in net interest income. Might be 2-3%, specifically quarter over quarter. And the revenue didn't really change too much either. And you can see that there was a little bit of a decrease in managed revenue, just probably by an factor of 3% or so. But the expense is also remaining relatively flat, but an increase of credit costs that you can kind of see here. And what they kind of then go ahead and break down is generally speaking, they end up with about 1.5 billion in charge-offs, which hasn't really changed. It's generally been flat in terms of what things have kind of happened with in 1Q and 4Q. And you can see the amount of builds that they've kind of had over the past few quarters and year over year quarter as well. So that's compared to about 1.5 billion in terms of charge-offs or reserve build and what have you. But in this case, in 1Q 2020, they took about a $6.8 billion reserve build in preparation for things like oil and gas investments and equity charge-offs and also consumer charge-offs as well. And so what you can then see is the impact that it had based off of taking this increased charge of about 8.3 billion, and it really impacted it by about $1.8 per share from the quarter over quarter, and about 1.9 ish or so for the year over year. So this is generally speaking above $2.50 or so in terms of the earnings per share that has now kind of been impacted pretty heavily. And you can see that definitely takes an impact on the return on total capital employed and the return on equity by a pretty significant margin. Yeah, relatively huge significant margin, to be honest with you. And not necessarily too sure what these are kind of referring to, maybe the difference in the capital builds and what have you. That kind of goes a little bit over my head, but this is a little bit interesting because it highlights more specifically the reserve build and how it's kind of broken down. And so you can kind of see how they've been doing some additional, I guess, being a little bit more conservative over the past 6 months or so with respect to charge-offs. I don't know if this was in anticipation of any of this happening, or maybe just being more cautious and being able to basically build up a reserve over the next couple years, just to be sure of when some sort of downturn did happen, they were prepared, and maybe they just got lucky. But you could see kind of coming into the fourth quarter of last year, they basically had about $14 billion or so in reserves for any sort of impacts like this. And then later in the year, they kind of had a CECL adoption impact, which I'm not exactly too sure what that means, but I think it probably means something about consumer credit lines or something like that. So they increased it about 4.3 billion from that, and released a little bit with respect to wholesale And then they ended up with this amount here, this 18.6 billion of everything. So a lot of it being related to credit card, a little bit of home lending, consumer debt, and then they basically have the overview of consumer debt and then the wholesale debt, which is probably commercial real estate and things like that. Then you see the big impact that they kind of took, which was an increase of about 6.8 billion compared to the last year's quarter, and that was an impact of about 4 billion for consumer debt, a little bit 300 million or so for home lending, which I thought was pretty surprising. Other consumers, about another 300 million. So for a total of all consumer debt, about 4.4 billion, and then additional wholesale, debt, basically being written off about 2.4 billion. And a nice little note here is basically talking about how this includes multiple sectors, so probably commercial real estate in there as well, which I think Wells Fargo does a really good job diving way too deep into some of that stuff, and that's kind of why the simplicity that JP Morgan did in this is something I really enjoy. And it talks about including oil and gas. So obviously they're impacted pretty heavily by the oil and gas impact of basically smaller companies probably not being able to come to debt or come to paying off their debt or being able to meet their debt obligations in the short term. And so that's where you get this 14.3 billion in terms of firm-wide reserves up to this 25.4 billion. So over 11 billion in terms of the past 2 quarters that they were able to build into the balance sheet for a situation like this. Now, I don't necessarily know if that was premeditated or what, but rather interesting. And then they kind of go a little bit more into where the loans are, how things are going, with respect to a little bit more into depth about what each individual amount is kind of happening with each individual sector, and talking about how net income is down, maybe the more headline-ish sort of things with respect to investment banking and wholesale payments and more things along those lines, and talking a little bit about the fixed income markets, and Wells Fargo does a bigger dive into this with respect to talking about equity losses that they've seen in the first quarter. So I don't know if that has to do with their trading platforms or doing any sort of backed securities that they kind of had in the past. And might as well just jump to it at this point. I think this is relatively all I want to talk about with respect to JP Morgan. But I think overall, I think what a lot of people are going to assume is, wow, JP Morgan took a big hit. But in actuality, the charge-offs at the moment haven't necessarily been too large at the moment. And I think it's mostly just an anticipation of later on in the year. So I think a lot of that is going to be built in the future quarters, where I think they will be able to take some of that cash to take any sort of impact in the future. Now, Wells Fargo did something very similar. They've obviously highlighted their COVID-19 response and talked a little bit about that. But the one thing I dislike, I guess, about Wells Fargo's approach is they kind of just went right into it. They said net income, hey, we're down. Of course, in 4Q19, they had a lot of write-offs associated with some of the litigation that they've been going on and some of the other things that have kind of happened. And so they took about a 2.5 or maybe it's $3 billion write-off or something like that for that. And then, of course, in the quarter over quarter, they obviously got hit again with respect to the expense for credit losses. So it's not nearly as big for Wells Fargo it is for JP Morgan, but JP Morgan then also has a lot more assets under management. So you can see that this is about a $2.9 billion reserve build for loans, which is smaller than what JP Morgan did, is almost half, if not more than half, of what JP Morgan did. And you can see they have a lot of other things for net charge-offs and expense builds for debt securities and securities impairments and net losses on equity securities from compensation plans and a lot of stuff like that, which I don't necessarily know if that impacted JP Morgan as much. And I don't necessarily know how that relatively comes in. But another thing that they mention here as well is they redeemed some of their Series K preferred stock and then reissued it, utilized something else. So that actually impacted the, or maybe that was JP Morgan that reissued. But these guys redeemed some of the preferred stock, which also reduced, because that's basically going to come directly out of some of the working capital and impact your earnings per share. So, yes, relatively interesting. Generally, a company that's able to at least make $1 or so in earnings per share is basically wiped out due to some of the charge-offs in the recent quarter. So, couldn't even make over 61 cents over the past 2 quarters in terms of net earnings. But a lot of that I don't think is actually going to be hitting the cash flow statement. I think a lot of that is just the mark-to-market accounting and write-offs that the company is seeing. So the cash is still coming in, the income is still coming in. It's just not being allocated to net income because they are basically reserving builds for any future losses in the portfolio. And they go on to talk about the liquidity position and where they basically were with respect to regulatory minimum from the government. So basically, they need to have, you know, $1 for every $10 in assets in here, and they are basically saying that they have about a little bit more than that, in just in case. So they're up about 100, or they're up about 21% compared to what they're supposed to be, because they're up almost 2%. 2 percentage points as a whole. So they're perfectly fine, right? That's basically what they're trying to say, is they're perfectly liquid compared to some of the other companies. And I think that this previously for Wells Fargo in like the 2008 2009 was about 7 or 8%, which just goes to show you the liquidity position has increased dramatically in terms of the amount of cash that they have on hand. In terms of normalized for the organization, it's probably 30 to 40% more compared to where they were, going from about 7% up to 11%. It's a huge increase in terms of cash that they have on hand to make sure that nothing like this, kind of happens, that they have the additional liquidity in case things kind of dry up. But yeah, you can see net revenue didn't really change all too much, but it did talk about a little bit by net interest income basically being flat, and then how the non-interest income was down by about 2.3 million, so, or billion, sorry. So yeah, you can talk about a little bit about the expenses here, just based off of what we talked about, and then they just continue to go back into some of the deeper details. Now, keep in mind that this goes on for another like 30 slides or so. So Wells Fargo dives real deep into it. They talk specifically about oil and gas and where each individual sector is, and they really dive deep to make sure people know and be transparent about what's going on. So I don't necessarily know if that's something that as a I guess younger investor, or maybe not a younger investor is the right term, but I guess individual investor rather than like a big investor necessarily cares about. All I care about is the cash flow and that aspect of things, and that they're taking precautions, which they are. They're taking about $3 billion charge to make sure that they have a cash reserve build in the short term to make sure anything else happens, that they can withstand that. But yeah, you can see that in general, if we kind of scroll back up, the impact to retail and oil and gas is relatively small, about 3%, and compared to everything. So with respect to the loans, commercial services, transportation services, maybe some retail being a little bit up by about 7%, but majority of it's about 30%. So I don't know if that's, just mortgages, or what exactly this is entirely being out for. If this is, treasury stock, who the heck knows? I'm not exactly too versed in that aspect of things, but you can see that they don't have 10, 20, or they don't have 20% of their entire portfolio in oil and gas, or retail stocks, or recreational transportation stocks, or anything like that. So in that respect, or not stocks, but rather loans. So in that respect, they're rather insulated partially to what's going on at the moment. And of course, I'm sure they have opposite action going on with supermarkets having their loans and those being obviously safe. Because you think about it, Costco's doing really well right now. A lot of supermarkets are doing really well right now because of people buying in advance, people buying, very much early on in the February and March timeframe. Now, if that means that later on in the year people don't buy as much because they have some non-perishables still at home, that's left to be seen. I don't know. But you can see nothing too drastically is changing with respect to net interest income, and non-interest income is where it kind of really comes in. And so I think this is a little bit about the investment aspect of things, and other aspect of what they're kind of looking for. So it doesn't really include loans or anything like that. That's under interest income. So uh, yeah, I mean, you got a lot of information in here, but just looking briefly at it and looking at the cash flow statements of both organizations, I felt like JP Morgan was probably the better buy just as a whole. And so I took a brief or quick position in it, about 10 shares at $95. I'll continue to build the position if it's below 95, and I'll definitely buy more and accelerate the amount that I'm buying if it goes below $90 a share. At the moment, just looking at the watch list here, you can quickly scroll over and see that the increase from the 52-week low for these is about 20% for Wells Fargo, 24% from JP Morgan. So in the case of where we were just a short while ago, Wells Fargo was down to $25 a share and JP Morgan was down to $76 a share. So I really hope that I could pick up more shares at these sorts of prices. But unfortunately, I don't think I will. But we'll see. I mean, we're not too far away. But one of the things that I'd also like to note here is that Wells Fargo is down about 45% compared to the 33, 32% that JP Morgan is down. So you didn't necessarily see as large of a peak to trough in JP Morgan as you did with Wells Fargo. And I think part of this is obviously due to what happened in the fourth quarter with Wells Fargo and their net charge-offs associated with what was going on with the litigation aspect of what was going on in their business in the fourth quarter as well. So that's all I really wanted to talk about today, guys. Just introduce the fact that I'm sharing this watch list with you guys, and also my small introductory position in JP Morgan, which I'm hoping to build over time, hopefully get close to 100 shares before this all kind of ends out. So hopefully getting myself to a $9,000 to $10,000 position, which will probably be about 2 to 2.5% of the portfolio size. So a pretty decent sized position. And yeah, can't really complain with that. That was the first take. So I think I'm just going to add a thumbnail and load it up, and hopefully you guys enjoy. More than happy to hear your comments down in the comments section down below. And I will talk to you guys on the next video. Cheers.